Hello and welcome back to the course on digital financial inclusion. In this course, we'll talk about voluntary versus involuntary financial exclusion. So we'll talk about what are the difference between these and how does a financial literacy or awareness define this voluntary and involuntary exclusion. So let's get started right away. So voluntary exclusion means that few people would like to voluntarily remain excluded. So which means that even if you provide them ecosystem, access, tools, technology, trust in their ecosystem, everything else, they will still want to remain excluded. The reasons could be different. They do not trust the system. They do not do or want the financial services. They think that their informal financial ecosystem is much better. So whatever you provide to them, they will want to be financially excluded. And then we have involuntary exclusion, which means people want to get into financial inclusion or into the formal financial system, but they do not have suitable products. So how do we deal with it? We provide them tools, we provide them literacy and awareness, then we give them governance, technology, access to financial services, and we ensure that whenever they want to buy a product, they have a suitable, affordable, useful, and as per their need product accessible to them. They can buy it anytime. So hence we cater more to involuntary exclusion, and for voluntary excluded people, what we do is that we create an ecosystem so that voluntary excluded person, once they see that people are getting into formal ecosystem and what are the benefits they are getting, they will gradually get influenced, and then they will understand that okay, the formal ecosystem is much better, or they might have a strong belief that why to get formally financially included. They will have their own beliefs and they may be right in certain extent, but then we have to create an ecosystem as a responsible government. So we also understand the financial literacy always means that there should be an adoption. That is the role of a sales, which means if I'm a salesperson, I go to a person and I say that these are the products and features of a product, we expect that the person should buy. However, in a financial literacy and awareness, it is more of a neutral term, which means even if you are making people aware about financial services and product, it may be a case that they think that, okay, I was using this financial product for so long, but now after understanding the benefits, features, and exclusions, I think this is not the right product for me, and I would like to wait more for the particular financial product or to the right financial product. So what I do is that I can drop that product. So hence financial awareness is a very neutral term. It could mean that a person does not want to buy that product anymore and can actually drop that product. So adoption is only related to sales and it cannot be related to financial awareness. Financial awareness and literacy means that you're making people empowered to create a right choice, to create an informed and much aware choice, so that what kind of product and financial services they want. So that should be the role of financial inclusion awareness. It should not be considered that whenever you are doing a financial awareness or financial literacy campaign, adoption will increase. So hence, it is important to, number one, identify what kind of inclusion we have to deal with, and hence accordingly we design the tools. In the next section, we'll talk about what are 3 A's of financial inclusion. So till now we were identifying what are different kind of exclusion, and now we are gradually moving into financial inclusion space, that what are different tools, practices, and strategies that we adopt to achieve this financial inclusion goal and to add more and more people into formal financial system. So see you in the next section. Till the time, think about digital financial inclusion. Thank you.